Welcome to VividBox HQ. The AI trade moved, and it left Nvidia behind. Four companies, 1 year, $660 billion. That's what Microsoft, Amazon, Alphabet, and Meta have committed to AI infrastructure for 2026, a 60% jump from the $413.5 billion they spent in 2025. The combined number is bigger than the entire GDP of Saudi Arabia. And here's what almost nobody is talking about. Most of that money flows somewhere the headlines have ignored. The GPUs that pushed Nvidia past $5 trillion in market cap in Q3 of 2025 take a smaller share than you'd think. Most of it pours into the dull, slow, unglamorous backbone underneath the chips. Power lines, transformers, substations, cooling towers, the shovels and turbines, the grid. The boring stuff your eyes skip past on the highway. Because the silent shift inside big tech this year is that the choke point of artificial intelligence has moved. Chips, for 2 years, were the bottleneck. They aren't anymore. Electricity is. And the companies racing to lock down that electricity, the utilities, the turbine makers, the cable manufacturers, are quietly becoming the new center of gravity for the entire AI economy. We'll show you exactly how badly Wall Street has missed this rotation, and why the next Nvidia might be a power supplier. Start with the chip story, because that's where this rotation begins. For 2 years, the entire AI trade ran through one assumption: whoever owned the most advanced silicon owned the future. Nvidia rode that thesis to a $5 trillion market cap in 2025. Apple hit $4 trillion. Alphabet, $3 trillion. The map looked settled. Then it cracked. Washington tightened export controls on the most advanced AI chips, locking high-end Nvidia products out of the China market. Competitors flooded into the gap. AMD with its rival accelerators, custom silicon from Amazon and Google, a wave of Chinese alternatives. Supply broadened. Margins, for the first time in this cycle, came under pressure. And the question every hyperscaler had to answer changed overnight. The conversation moved from supply to survival. Can we power what we order when we order it? A chip without electricity is a paperweight. A data center without a substation is a parking lot. As the four giants scaled their order books, they ran headlong into a wall their accountants had not priced in. The United States grid does not have the capacity to feed what they're building. Capital started to rotate. The destination wasn't out of AI. It moved into the layer of AI nobody had been watching: the wires, the watts, the steel underneath. Look at the slice in red. Data centers will swallow 11.6 gigawatts of new North American power capacity in 2025. 1/3 of every new gigawatt being added across the entire continent. One industry taking 1/3 of the grid's growth. In Virginia, data centers already eat 25.6% of the state's electricity. The constraint on AI is no longer silicon. It's the socket in the wall. A third of the grid is a number on a slide, until you see what the companies are actually doing about it. Microsoft has signed a 20-year deal to restart the idle reactor at 3 Mile Island. Yes, that 3 Mile Island. The site of the worst nuclear accident in American history, the place that effectively froze new U.S. reactor construction for a generation. Microsoft renamed it the Crane Clean Energy Center. The reason is brutally simple. Data centers need clean, steady, around-the-clock power, and the cheapest way to get it is to switch a dormant reactor back on. Google followed with its own move, backing 3 new U.S. nuclear sites in partnership with Elemental Power, an advanced reactor developer. Then Microsoft cut a separate $10 billion deal with Brookfield to build out clean energy projects across the U.S. and Europe. These deals sit far beyond the ordinary power purchase agreement. Big tech is now buying baseload generation directly, because waiting in line behind ordinary utility customers is no longer an option. Meta has sold $57 billion in bonds to fund data center construction. Alphabet has sold $25 billion. The capital is real. The reactors are real. The message to every utility executive in America is unmistakable. The buyer is at the door, and the buyer is impatient. Watch the gap between those two bars. Big tech capex jumps from $413.5 billion in 2025 to $660 billion in 2026, a 60% leap in a single year. The four largest tech companies pulled in $1.8 trillion in revenue in 2024 and over $410 billion in profit. They are spending all of it, and then some, on infrastructure. This is the most expensive land grab in corporate history. There's a reason this race is happening on American soil. The United States holds a structural lead. Cheap natural gas, deep capital markets, and a permitting system that still lets private companies build generation. China races ahead on solar and grid build-out, but its hyperscalers answer to state directives, not capital allocation. Europe is in a different bind entirely. Power prices are higher, and the remaining nuclear fleet is being shuttered. So the gravity of AI infrastructure is here, in America. According to the research, on current trends, non-hydro renewables will reach roughly 24% of U.S. generation by 2034, up from 18% in 2024. But that transition is slowing because federal subsidies have been pulled. Natural gas, what's left of nuclear, and an aging grid will carry the load. Industrial demand from data center growth has reshaped consumption patterns even beyond traditional peak hours. In Virginia, data centers already account for over a quarter of all electricity demand, and that's before the next wave of construction breaks ground. The leverage is enormous. Whoever supplies the watts now sets the terms of the next decade of computing. The trend the numbers expose is simple. Electricity is the new oil, and every capital allocator on Earth is starting to see it. Every commodity boom in American history has ended the same way. Too much capital, chasing too few permits into a wall of regulatory delay. Consider what the queue actually looks like for the build-out these companies have promised. Transmission lines in the United States routinely take many years between filing and commissioning. Lead times for the heavy gear, gas turbines, large transformers, switchgear, have stretched so far that a hyperscaler can sign a contract tomorrow, but the steel itself cannot show up tomorrow. Meanwhile, utilities have to raise tens of billions of dollars in fresh capital to upgrade substations and lines that have been sitting in the ground for decades. Rate cases get filed. State commissions push back. Residential customers, your neighbors, your parents, start seeing their electricity bills climb because the grid is being rebuilt around data centers. That's where the politics turns ugly. Boom-bust cycles in infrastructure do not end gracefully. The research itself flags this risk. Profitability and monetization of the massive AI capex remain unclear, with adoption of AI services still relatively low despite the scale of deployment. If returns disappoint, half-built substations and over-ordered turbines turn into stranded assets fast. The pattern is older than the technology. The timing of the unwind is the part nobody can call, which raises the harder question. For the people watching this with money on the line, how do you play it? Which leaves the question every investor is now asking: where does the money actually go? Based on what the research shows, the winners of this phase of AI sit far from the names on every magazine cover. The boring ones win. The utility holding companies running nuclear fleets in Pennsylvania and the Carolinas. The turbine manufacturers with multi-year order books, the HVDC cable makers, the independent power producers that can sign 20-year contracts with a hyperscaler and lock in returns. Some analysts suggest that the next decade of AI returns will look less like the dot-com era when software ate the world, and more like the railroad era of the 1880s, when the real fortunes were built by the people who owned the right-of-way. Pull the camera back. A story that began about chips became a story about chip margins. From there, it widened into a problem about power, then a problem about permits, then the single biggest opportunity in industrial America in 50 years. The picks and shovels won the gold rush. They always do. The question now is not whether AI changes the world. The question is, who owns the wire when it does? If you're tracking where capital actually flows, you know where to look. Like, share, and subscribe for the hidden trends that move markets. See you tomorrow.